Just want to say good afternoon, everyone, and thank you for joining us today for our Adapting and Innovating Beyond COVID-19 webinar series. Today's webinar is focused on filing your taxes, something that's super important for all small business owners like yourselves. My name is Elvis Wong, and I am a co-chair of the Loan Review Committee here at Access Community Capital Fund. As you're all familiar, Access is a registered charity with the aim to give everyone in our community the opportunity to reach their potential through sustainable employment and self-employment. So if you would like to learn more about what we do, please visit our website at accessccf.com. Just before we get started today, I wanted to go over a couple of housekeeping items. So first, if you're new to Zoom, there's a menu bar located at the bottom of the screen. And in this bar, you can find that there's video, sound, chat box, and a Q&A chat box as well. So for the purpose of this webinar, all of your mics are going to be muted. We'll only have myself and Stanley, who's going to be our presenter, speaking, just to ensure the best sound quality. So that means that if you do have any questions for the speakers throughout the webinar, there's a Q&A chat box at the bottom of your screen. So please just type out your questions as they come in that Q&A box, and we'll either address it during the session or we'll have about 10 to 15 minutes at the end of the session to go through all of your questions. Me personally, I'll also be answering some of your questions via the chat as well. And then if you have any tech-related issues or general questions, please type those questions in the general chat box rather than the Q&A box, and we'll post any links and try to help you and guide you if you have any technical difficulties. And Michael from Access is also on hand as well to address any concerns. So without further ado, I wanted to introduce our presenter for today. So today's presenter is Stanley Xu. And Stanley, he's a staff accountant at a mid-sized public accounting firm. So his experience is around corporate and personal taxes, accounting, and assurance. So Stanley has an undergrad degree in business administration and a master's degree in accounting, and is currently pursuing his CPA designation. He is also a volunteer with the Access Community Loan Review Committee and a business coach with the Women's Business Accelerator program. So he's very qualified today to lead the session on submitting your taxes and how to file your taxes. So without further ado, I want to introduce Stanley, who will now take over the session.
Thank you, Albert. So without further ado, let me just jump into the topic of file your taxes return for small business owners and freelancers. During today's presentation, I will be covering 5 areas of your corporate and personal income tax. That started with deciding your business forms when you start your business. Then we will progress towards prepare your books. After that, we will talk about how to get ready for tax filings. And then we will discuss some points that you should know, some expenses that you can claim when you file your taxes. After that, there are ongoing CRA correspondence related issues that you should always watch out for. So I understand that there are audiences who already started their business, or there are potential business owners who are looking to start their businesses. And for small businesses, there are usually 2 very different forms. One is sole proprietorship. The other one is corporation. For sole proprietorships, it has very different tax filing requirements than corporations, and also a salaried individual person like me. So for a salaried individual, the tax filing requirement is personal tax filing once every year. For self-employed individuals, you also have to file your personal tax, but in addition to that, you also have to include your self-employment income on your personal tax. For corporations, in addition to your personal tax, you also need to file a separate corporate income tax return. The filing deadline for regular or salaried individual is April 30th, However, under the current COVID-19 situation, it has been extended to June 1st, 2020. For self-employed individual, that means anyone who has self-employment income, the regular filing deadline is June 15th. Under the COVID-19 situation, it remains at June 15th, 2020. For corporations, regular filing deadline is usually 6 months after year end for small businesses. Under the current COVID-19 situation, it has been extended. So if your year end lies between September 19th, 2019 to November 30th, 2019, it has been extended to June 1st, 2020. Besides the tax filing deadline, there's also a different tax payment deadline. For a salary individual, it is the same as the tax filing deadline, that is April 30th. For self-employment individual, although you only need to file your taxes on June 15th, you have to pay any tax installment or any balance owing to CRA before April 30th. For corporations, the tax payment deadline is usually 3 months after year end. And under COVID-19, the payment deadline for corporations has also been extended to September 1st. If the year end is between December 18th, 2019 to May 31st, 2019. The same deadline, September 1st, 2020, also apply to salaried individual and self-employment individuals. The costs of tax filing can be drastically different between individuals, corporations, and small businesses. For a very simple personal income tax return, it can be $50 and up. If you have self-employment income, accountants can charge you $50 to $500 more, depends on the complexity. And for a corporate income tax return, the costs are usually $500 to $2,000 per return. So let's look at some scenarios here. In scenario one, individual has a part-time job which pays $20,000 a year. And she also receives a $20,000 salary from her own non-incorporated clothing business. So for her, the self-employment category applies here. The tax filing requirement for her is only personal tax return. So the regular filing deadline for her is June 15th, and that remains the same under COVID-19. And she has a tax payment deadline of April 30th, which got extended to September 1st, 2020. In scenario two, we have an individual who also got paid $20,000 from her part-time job, but she received salary from her incorporated clothing business. And the corporation has a year end of December 31st, 2019. For her personally, she has to file her personal tax return once every year, and her regular filing deadline is April 30th. And under COVID-19, it is June 1st. She has to pay her tax payment before April 30th, and under COVID-19, she has to pay her payment before September 1st, 2020. Her corporation, on the other hand, have to file a separate corporate tax return. The deadline for that return is June 30th, and that remains the same under COVID-19 situation. The tax payment deadline is March 31st, and under COVID-19, it is extended to September 1st, 2020. So some people may ask why you then choose to incorporate them because of the extra burden of an additional return, and you also have to pay more to file your corporate income tax. So let's look at the effect of incorporation. So the 3 column here shows 3 different scenarios. The first scenario is a person who incorporated his business and withdraw 0% of the income. That means all the income is retained in the corporation. In this situation, when the business generates $20,000 of net income, he pays $2,500 of corporate income tax. The corporate income tax is 12.5%. That includes both federal and provincial portion. So that person's net income after tax in the corporation is $70,000 and $500. At the same time, beside his clothing business, that person also received $20,000 from his part-time job. So because he didn't take any salary from the corporation, his total personal income is $20,000 from the part-time job. And the personal tax rate in that bracket is 11%. So his personal tax expense is $2,240. That will give him a net income after tax of $70,760. So if we add up all the tax paid on the corporate level and on the personal level, the total is $4,740. If we take all his income, the $20,000 from the business and $20,000 from the part-time job, and less total tax paid, he would have $35,000, $260 cash left after paying off all the taxes. In the second scenario, that person withdraws 30% of the earning in the corporation. So if the corporation makes the same $20,000, he pays himself $8,000. That would leave $12,000 net income in the corporation. After applying the 12.5% corporate income tax rate, he would have a net income after tax of $10,500. To compute his personal income tax, we have to add his salary from the clothing business of $8,000, add it to the wages from his part-time job of $20,000. That brings his total personal income to $28,000. In that tax bracket, the personal tax rate is 16%. So his total personal tax expense would be $4,580. That would leave him a net income after tax of $23,490. If we add up his corporate tax expense and his personal tax expense, it is $6,080. That would leave him $33,919 cash for reinvestment. And the last example is a person who did not incorporate, who remained as a sole proprietor. So all the $20,000 he earned from his clothing business would add straight to his personal income, as well as his $20,000 from his part-time job. That would bring his total personal income to $40,000. At $40,000, the personal tax rate is 19%. So we can see the trend here. The higher the personal income, the higher the personal tax rate. However, for corporation tax, as long as the corporation remain as a small business, the corporate tax rate is always 12.5% in 2019. So for sole proprietorship, the total tax paid is $7,792, which is the highest among all three. That will leave him the least amount of money, at least the least amount of cash. So if we compare the numbers here, in the first scenario would leave the owner the most amount of cash to reinvest, and the last scenario will leave the owner the least amount of cash to reinvest. So that will bring to my next point. Why should you incorporate then? Most people incorporate for the tax planning opportunity. You are able to defer your taxes. But remember here, it's tax deferral, not tax avoidance. So if we look at this slide, although the first scenario would pay the least amount of tax in the current year, but in the later years, if you have to take more money from the corporation, you will still pay personal tax. So at the end of the day, there is a perfect integration of personal and corporate tax. That means no matter how you structure your payment from your corporation to yourself personally, you will end up paying the same amount of tax. There are also other business reasons to incorporate, such as to avoid liability and protect your personal asset. So you may ask, who then should incorporate then? So if we look at the example here, if you are a person who really needs to take a lot of cash from your corporation, or you have to use it to pay your household bills, to pay it to buy a home, maybe incorporate is not the best scenario for you in this particular moment. But if you are someone that has some extra income from the part-time job, so that you don't have to take out any money out from your corporation, it might be a good idea to incorporate, because as we can see in the first scenario, in the year when you make money in the corporation, you don't have to pay as much tax as in the second and third scenario. So the next session here, we are gonna talk about how to prepare your books. No matter which business form you choose, whether you choose to incorporate or whether you choose to remain as a sole proprietor, you still have to do bookkeeping. And bookkeeping is a very important task to do during your day-to-day operation. Not only it helps you to gather all the evidence when you prepare your tax return in the end, but having a very detailed, clear set of book helps you to understand your financial performance. You will understand how much cash you have in your bank, because sometimes when you write checks and you receive checks, there are delays between when you deposit them in the bank and when they show up on your bank statement. So having a proper bank reconciliation can reduce the risk of overdraw from your bank account. So besides that, there are also the benefit of report accurate amount of tax. whether you need to summarize all your expenses and incomes. You have to do that for your income tax, and also you have to do it for your sales tax. So some people may ask, if I don't have too much experience preparing my book, or I don't have as much knowledge of accounting, should I consider to hire a professional to do it? So there are different kinds of professionals you can look for help if you want someone to do your books for you. For example, you can hire a individual bookkeeper who would charge you $50 per hour, or you can have an accountant to do it for you at the end of the year. They will charge you around $100 an hour. My suggestion is, if you have less than 30 transactions per month, so if you are just starting up, you may want to try to do it yourself. And if that didn't work, you can always leave it to your accountant at the end of the year, when they can do everything all at once. So there's going to be some synergy over there to save you some money. If you have between 30 to 100 transactions per month, you can do it yourself, or you can consider to hire a bookkeeper who will give you a monthly report of all your expenses or your incomes, so you can have an overview of what happened during the past months. If you have more than 100 transactions, I would strongly recommend you to hire a bookkeeper to do it for you, because as you get more business, as your business get more complicated, so will the bookkeeping process, and having a dedicated bookkeeper will help you to get organized and keep all the records. With that being said, if you decided to do it yourself, there are really great softwares and tools out there that you can utilize. The most common and the most cost-efficient one is Excel. There are templates on the internet you can download. However, with Excel, the problem is you have to set it up properly, otherwise it may give you the wrong result. You can also go with QuickBooks Online, which gives you a very good value. It is only $10 to $20 a month, and you pay it monthly, and it is all set up for you. You just have to, and you get to do it everywhere, whether it's on your phone or on the website. You can take a snapshot of your receipt, or you can record your auto mileage on the app. It is a very convenient option. Also, there's the option of QuickBooks Desktop. It is the most powerful version. There's a lot you can do with it. You can do a lot of complicated things. For example, capital asset, and it is the most powerful things out there. And when you do it correctly, it can be very easy when you get ready for prepare your tax return. So after you prepare your books during the year, when you approach the year end, you want to prepare, get ready for your tax filings early. And there's a couple tips I want to give you guys to better prepare your tax return, tax filing package. Some of the things you can do, such as do a summary of all the items that you want to include in your tax return. Do a summary of all the amounts. do a summary of all the relevant events that happened during the year, and write detailed explanation of complicated items. For example, you can do something like this for the summary of relevant event. On February 10th, my friend loaned me $10,000 for purchase of supplies. So that way, when your accountant look at your bank statement and see $10,000 deposit on your bank statement on February 10th, they're gonna know it's a loan. It's not a income, so they can record it correctly. For example, on August 20th, I paid back my friend $10,500 for interest and principal. So your bookkeeper or your accountant is gonna know when they look at your August bank statement, when they see $10,500 of withdrawals, they're gonna know that they should record $10,000 for a loan repayment and $500 for interest expense, instead of recorded as a supply or recorded as some other expenses. And for list of items, you can do it like this. You can put T4, $30,000. So your accountant knows that on the T4, you should have $30,000 of income. Self-employment income, $30,000. So your accountant, instead of going through all your bank statement or going through all the invoices, they're gonna know that the total self-employment income is $30,000. You should do this even if you want your accountant to do your books for you, because without a summary, they might miss an invoice or they might miss a receipt. By giving them a good summary, they're gonna agree the invoice to the summary you give them, so that they can have a better idea and they have more comfort filing your taxes. For example, if there are some more complicated items, like if you buy a ladder, you want to provide them an invoice attached, and then do a detailed explanation. $1,000. Last year, I purchased a ladder for my roofing business. So when they see that $1,000, they're gonna know it is equipment instead of personal loan you take out from the corporation. So when you finally get your tax filing package ready, you are finally ready to file your taxes. File taxes can be rather difficult. So if you want to hire someone, so there are a lot of accountants out there. There are big firms and there are small firms and there are mid-sized firms. For a small business, you don't need to go to those big firms because they are more specialized in big company assurance or big company taxation. You can go to a sole proprietor, or you can go to a mid-sized firm with 10 or 20 staff. That way they are more familiar with your situation and they can give you more personalized attention. If you have a more complicated tax return, you should consider hire a CPA who has done an extensive period of training and who has a very long time of experience. And one thing you should always do when you after you file your taxes is to read your notice of assessment, as that's how you know that your accountant did a good job, or whether you missed a slip, so that you can really see if everything was done correctly. having an accountant to do your tax can be expensive sometimes. So I want to give you some tips on the ways you can reduce your accountant bills. First of all, you can organize your document. Like I mentioned in the previous slide before, uh, provide your accountant with a summary and also more detailed information so that they can spend less time to flip through your invoices. In that way, the less time they spend, the less they will potentially charge you. You can also provide them with soft copies. So, for example, if you did your bookkeeping in Excel, you want to give them a soft copy of the Excel files so that they can change things fairly quickly rather than give them a PDF and they have spent more time to figure things out, figure the formulas out. And the most important things and the easiest thing you can do is always ask them. Ask them before they even begin to do your tax. Ask them, what can I do to have you reduce my bills? They might tell you, give me a good salary of what's the list of things happened during the year, or give me more detailed information, and or they will even tell you, prepare your HST yourself. So besides having an accountant to do your taxes, if you just started and if there's not much activity in your business, you can also consider to do your taxes yourself. There are free online softwares out there like TurboTax that you can file your taxes for free online. It is very simple and easy to use tools, but however, without professionals really look at or review your returns, there are possibilities of errors, and there also might be possibility that there are tax credit or tax deductions that you didn't know, and you end up paying more taxes. So running a business means that you have income and you also have expenses. And for tax purpose, you always want to minimize your income and maximize your expenses within the legal boundary of taxation. So there are expenses that are fairly common, or there are expenses that you may not know of, but you can actually deduct it on your tax returns. For example, business operation expenses, that is the expense of supplies, the expense of salaries. So when you hire someone, you pay them salaries, that's our business operating expense. However, if you are starting your small business at your home, you may also able to deduct some home office expense. With that being said, it is important to calculate your home office expense correctly. The right way to do it is divide the home office space. So the space that you use exclusively for your for activities that related to your business operation, divided by the total footage of your whole house, and use that percentage. You can apply it to mortgage and times the mortgage interest, the utilities you pay, the insurance on your house, any security system you install, or even repairs and maintenance of your house. Other things that you can claim are travels, equipment, equipments, I mean computers, machineries, so anything that are related to your business operations. You can also claim a vehicle expense, which is kind of similar compared to home office expense. You divided the portion of your business use, that is, how many kilometers you use for your business purpose. For example, if you drive from one client to another client, that's the mileage you should record, divided by total mileage you drove on your car for the whole year. And then use that percentage to apply it to your lease payment, your gases, insurance, repairs, your license, or if you finance your car, you can apply to your interest. If you bought your car with cash, you can claim depreciation on your car. But with that being said, you should keep a good log of the travel distance on your cars and carve out the personal mileage portion. There are also other expenses you can claim, for example, meal and entertainment. If you take a client out to a Raptors game, or you take a client out to Moxie to have a nice dinner, you can claim 50% of the expense and 50% of the ITC, that is HST you claim. That is the HST on the meals and entertainment you pay. However, you should only claim the expense that are related to the client, not your personal portion.
And Stanley, I just want to jump in here. So for those of you who don't know, I'm Elvis. I'm the moderator for today, if you joined a bit later. So one of the questions, if we go back to the previous slide, one of the questions in the chat from Jane is, when one uses their home or phone for business, what portion should be used as a business expense? So we talked about the home portion. Can we just quickly talk about the phone as well?
Yes. So of course. So the same theory applies to phones, whether it's if it's a home phone or it's an internet, you include it in your home office. But if that's your cell phone, so you have to calculate the percentage you use for your business versus the portion you use for personally. That can get tricky sometimes when CRA really wants to audit you. So they're gonna ask you to provide the phone bills, which includes a log of all the phone calls you make during the month, and ask you to mark out which phone calls you made are for business purpose, which phone calls are made for personal purpose. So you really don't want to be too aggressive on the phone bills. From my point of view, I would say maybe 10-20% of your phone bills you should probably claim, but you shouldn't really go for 80%, 90%, because that's when CRA want to ask you to provide more proof. I hope that answers your question.
Great, thanks, Stanley.
So here we can see this is a personal tax rate table for 2019. So if we look at the rate on access, that means, so if you earn, or your income is between $0 to $12,000, you pay $0 on the income tax. If you have $12,000 of income, every more penny you earn, you pay 15% of taxes, and the rate keeps going up to 53%. And just like we talked earlier, before, the combined federal and Ontario small business tax rate in 2019 is 12.5%, and it is almost perfect integration of corporate tax and personal tax. Here is a summary of HST related items. So if you do not have more than $30,000 of sales over the course of 4 consecutive calendar quarters, you are deemed as a small suppliers. That means you do not have to register for HST. That means that you do not have to collect HST on all your revenues. That also means that you do not get to claim HST on the expenses you pay. For example, when you pay your phone bills, you do not get to claim 13% of ITC back on the phone bills. If you exceeded the $30,000 threshold in a single calendar quarter, you are no longer a small supplier, and you have to start to charge HST on your revenue. For example, if you sell clothes, if you're a small supplier, you can just charge $100 per jacket and do not have to pay anything to the CRA for the HST portion. If you exceeded the $30,000 threshold, you may want to consider to charge $100 plus $13 HST, because the $13 you have to remit to the CRA. So, but there's also reason to volunteer register for HST, even if you are a small supplier. That means you are below the $30,000 threshold. For example, if you sell produce that are zero-rated supplies, for example, you sell vegetables, or you sell your supplies to businesses outside of Canada, you do not charge HST on those items, but you may want to still register, because you can claim your HST ITC on the expenses you paid. For example, the supplies you bought, or the phone bills. Another reason to register for HST if you're below the $30,000 threshold is if you have a large upfront spending. So, for example, when you first started your business, you bought a very expensive machineries. For example, $10,000. The HST on the machinery is 13%. That is $1,300. If you register for HST, you can get that $13,000 back. But if you did not, you cannot claim it. So you always want to keep your supporting document to support your HST claims. For example, invoices, receipts, contracts, agreements, and you always want to keep them for more than 6 years. So after you file your taxes, sometimes CRA may want to come back and ask questions about the expenses or your incomes. And the interest and penalties for misfiled taxes can be pretty hefty. The penalties is the greater of $100 or 50% of understated tax, plus 5% of balance owing, and 1% each month of the outstanding balance. So you always want to record and report your taxes as correctly as possible, and keep all your record and backup. Things like car mileage log, invoices, contracts, bank statements, tracking images. CRA can come to you to audit stuff that for the past 7 years. So always keep your record for more than 7 years. So with this, I pretty much covered the whole cycle of corporate tax and small business tax. I want to open the floor up for any questions.
Great. Thank you so much, Stanley. So I know some of you have put some questions in the chat already, but if you do have any other questions, please feel free to put it into the Q&A part of the webinar and we'll go through them. So I'm going to go get started with a couple of these questions. So one of them we touched on a little bit right at the end there, but somebody had asked what are the penalties of not doing your taxes on time at all? So I think that's the previous slide. Can we just talk about, I just want to reemphasize this point. So, can you just expand on this a bit more? So what does that mean financially for people?
So let me give you guys an example here. For example, if you accidentally overstated your 2015 professional fee by $2,000, for example, you only incurred you actually only incurred $5,000 of professional fee, but you reported $7,000. That means you overstated your professional fee by $2,000. That means if you do the calculation, the $2,000 times 50% times 12.5. That is 12.5 is the corporate tax rate, and so that gives you around $125. That is a penalty, plus 5% of balance owing. So 5% times 125. That is around $6, and you also add 1% of interest each month. So over a year, it's 12% of interest.
Great.
So at the end of the day, it's gonna be $200, $300 of penalties for only $200 of tax savings. So if you really think about it this way, it's not really worth it to overstay your expenses.
Yeah, and it's definitely a heavy penalty if you do file your taxes late. So it makes sense to kind of try and do it on time as much as possible. So then on kind of a similar question was, under what circumstances can the CRA then freeze your accounts? If you're able to answer that.
Freeze your account means freeze your bank account.
Yeah.
I do not really have any experience with this, and I don't really heard about that often. I seriously doubt that really happened to small businesses.
Yeah.
What they usually do is they just keep charging you interest on your CRA account. So, but they never go there to really freeze your bank account. That's to my knowledge.
I would agree for that. I think for a small business, likely that's not something you have to worry about. But they will eventually, they'll keep on bothering you for and charging you more if you don't pay your taxes. So a kind of a separate type of question is just around, let's say a company is incorporated in May 2019, and at that time they had decided a tax cycle from May to April, let's say. And then during the process of that incorporation, so they decided a certain tax cycle, but then before they wanted to file the first tax return, they actually want to change their tax cycle to, let's say, January to December. So let's say they kind of did something, decided to change how they want to do it. Like, how would they go about doing that?
They can always change their tax cycles, as long as it is less than a year from the beginning date of their the first day of their business operation to the day of their chosen year end. So they can always file election to change their year end with CRA.
Okay. And then somebody had asked, Thuraya had asked, do you have any recommendations for software or apps that we can use to keep a record of receipts?
I do not personally have any experience with that, but I think QuickBook Online have that option. So I think there's an app you can use to take pictures of the receipt and helps you to keep a record of it. I think it even picks up the amount, the HST for you. So it kind of integrated into your accounting system.
Yep, and I also see there's a couple of folks that are providing recommendations in the chat. So QuickBooks was recommended, again, Receipt Bank, Wave, FreshBooks. So if you use any of these accounting softwares, they should have some sort of functionality to take pictures and manage your receipts. Otherwise, you can always just take pictures yourself, but those ones will categorize it a bit easier. Christina had asked, if you win prize money in a business competition, do you have to complain it? Do you have to claim it as income?
A prize in business competition. Yeah, I would say yes. I know that lottery money, you don't have to pay any tax on it, but business competition, I would think it will be expenses, because if we think about it this way, if it is an expense for some other business, it's going to be income for your business. So I'm 99% sure the other side is going to take an expense on the price they give you. So you probably will have to pay, include it in your income.
Okay. So keep on putting your questions if you have any. I also have some other questions that I would like to ask. One is around HST. So we talked about if you make over $30,000 a year, you have to start start charging HST, and then so how would you manage your HST like remittance at the end of the year? What's the process for that?
So for HST, what small business usually do is at the end of the year, when they are doing their corporate income tax, they will also do it at the same time, because HST return is relatively a more simple return compared to corporate income tax. And I think maybe 50% of small business owners, they do their HST by themselves, because it is fairly easy. It is only usually 4 numbers you have to put on that return. It's going to be your total revenue of the year, and then that's total HST you collected. If you are selling normal goods or service in Canada, in Canada, it's usually 13%. And then you have your ITC, which is the import tax credit. So that's the total of HST you paid on all your expenses and supplies.
And then the idea is you just pay the difference, or if you've paid more HST than you've gotten, but then you can actually get money back.
That's correct.
Great. And actually, so Helen has a question on HST in the chat, so I'm going to read this. So Helen says that she's a sole proprietor and file HST payments every quarter using the quick method.
Okay.
And usually get 1% back during the first 2 quarters. And then her accountant would add all the HST she has kept and add it as income. So why does she do this when the 1% is for me to keep, as per the conversation I had with a CRI agent?
Sorry.
Yeah. Does that make sense?
A rather long question. Let me try my best to answer this.
Yeah.
She is from what I understand, her accountant is right. So because there are the regular method and there's a quick method, and for quick method, how it works is it didn't really, you don't have to keep a record of all your expenses. It's just a percentage of the income. So, but any just like how her accountant did it, it is add back to her income because it is income. It is money she got. It is not. It is different than when you do it in a regular method, when you have an actual calculation of your expenses and your HST collected, and that way it is actual like an HST difference, but in her way, it is kind of an income for her.
Okay. Yeah, and Helen, I guess I think if there are follow-up questions or if that wasn't clear, Michael had sent in the chat. There's you can reach us at accessccf.com and send any follow-up questions, and either someone from Access or me and Stanley can try and answer again via email. One other question that I had previously was just, let's say you start as a sole proprietor, like can you start as a sole proprietor when you're first starting out and then later incorporate, and how would that work?
I would say 90% of small businesses start as a sole proprietor. And later down the road, when their business got expanded and there's more transaction, or just like I mentioned, when there's excess cash that in the business that says as they feel like they don't have to take all the cash out, they can start to incorporate. And it is fairly easy process to incorporate. So you just have to register with CRA, register with the province of Ontario. And so from the day you register, everything happened in the corporation becomes a separate entity than your personally.
Another question that just came up is if you're an incorporation and you're the owner and you're looking to pay yourself, do you recommend implementing payroll and claiming personal income, so getting salary like on a regular basis from your company, or do you just recommend them taking this money out of their account as an owner at certain points of time?
So it is a really complicated question because there are advantage and pros and cons of each method, and they are the most two common method. One is salary and the other one is dividend. So and as I mentioned in the slideshow before, it is almost perfect integration. So no matter how you take the money out of your business, you end up paying almost the same amount of taxes, but there's going to be small differences. For example, a couple $100 of maybe health tax, or maybe sometimes CPP or EI. That's going to make a little bit of difference, but I would think you really should discuss that with your accountant, because it really needs a lot of background information and a lot of knowledge of how you operate your business and how what's your personal tax situation is.
Yeah, so just to add on that note, like one of the other things that you may want to consider in terms of payroll versus taking money out of your account is that just the cash flow of your business. So if you're not, like let's say you promise yourself, you implement payroll and you're paying yourself $2,000 each cycle, right? Now you have to make sure that you have that much in your business bank account, right? You don't want to, because it's regular. So if you're unsure about like how much money you have in your bank account, then it will be a bit trickier to implement a regular payroll versus kind of waiting to see how much money you've made and then claiming and then taking it out at the end. I think Stanley, correct me if I'm wrong.
That's absolutely right. So if you are late on your payroll, you're also subject to interest and penalties on your CRA payroll account. So that's really another thing to consider.
Yeah. So I want to note that it's new now. So we've done our hour. If you do have like one more question, feel free to add. But otherwise, it seems like we've addressed most of your questions. I really want to thank Stanley again for coming in here, doing the presentation, teaching us about taxes, and then answering all of your questions. The webinar itself has been recorded, as Michael has noted in the chat, so we'll share the webinar link, as well as we've created, Stanley has created a 2-page handout, so we'll share that via email just so that you have reference. And we welcome you to revisit the content and share it with your network. You'll also receive a webinar evaluation. I think that your feedback will really assist us in planning our upcoming webinars. And you can also provide suggestions for future topics that you want us to cover. Michael has also just shared kind of update new webinars that will be coming in the next couple of weeks as well, if you want to check that out. So thanks again for joining us. I want to know, so Helen said that she had one more question. So if you don't mind, Helen, if you type that out, maybe me and Stanley can answer that quickly. But then otherwise, yeah, thanks everyone for their time, and you have to go, feel free to drop off. Great.
Thank you, Alice. Are we waiting for the question?
Yes. Let's wait for Helen. We'll give you. Okay, so Helen's question is that her accountant would not let her write off medical bills. So wondering why.
Incur corporation or incur personal?
Yeah, Helen, is that for your personal taxes or for your slash self-employment or for your corporation? Okay. For self-employment.
So medical expense are usually, there are medical expense that you can claim on your personal tax return. And it is usually, but it depends on how many medical expense you have and how much your income is. It's usually, it have to be more than 3% of your income. For example, you have $20,000 of income. So you apply, you multiply that by 3%, that is $600. So if you have less than $600, there's nothing your accountant can do because it is the rule set by the CRA. But if it is more than $600, in the case of $20,000 of net income, it should be, it can be, if the medical expense met the criteria of CRA, it most likely can be added to your personal tax return.
Great. Okay, hopefully that answered your question, Helen. Otherwise, yeah, thanks everyone for your time, and we'll end the session now, and hope this was useful for all of you. So thanks again, Stanley.
Thank you, Elvis.
Bye.